Well, so rates are cycling down in the United States, but the permanent long-run equilibrium interest rate is low and it's staying there. It's not going back up. So investors have to get out of their head the notion that we're going to go back to 4%, 5% longer dated yields in the United States, or even really much above 1% in Europe. I think that over any conceivable investment horizon, that should be the outlook. So it's ways to now reorient your portfolio in that kind of environment. If you look at a portfolio that would generate 8 to 9% returns on average, generally your base rates would generate 400 to 500 basis points of that. Your risk premium would be the rest. Today you have to accept more subordination. The risk premium, the risk that you're taking in your portfolio, has to increase to hit those sorts of returns.
What about the kind of broader global growth environment and the amount that we're focusing on central bank action and whether or not that's going to be the crucial factor to change the direction and momentum of growth?
I think we focus too much on central banks, of course. And I think that we're in a structural malaise where this period of low growth is going to persist. There's really not much that central banks can do about it. We do have a fiscal policy lever. And I think that one of the key implications of a lower for longer environment is that there's more fiscal space than we thought. So in places like Europe, you have a very odd policy mix where you have negative interest rates at the same time that you have roughly budgets in balance. And I think a much more appropriate mix would be budget deficits of 3 to 4% of GDP, actually similar to what we have in the United States right now. And I think that could change savings and investment relations in ways that actually allow for rates to move up somewhat and have somewhat faster trend growth.
But would it, though, if you think about we had that fiscal stimulus, that huge tax cut at the end of 2017. So we had 1 year of a bump in growth. We tacked on $1 trillion to the deficit, and now here we are coming back, right, to trend for all intents and purposes. So how do we continue to do that?
I'm really not talking about a fiscal stimulus or a cyclical move. I'm suggesting that on a longer term basis, we can have larger budget deficits than we thought previously. Now, we shouldn't get carried away.
Because rates will always stay low, what happens when they go back up again?
Well, again, this is what's...
He doesn't think they're going up.
But that's precisely the point, that once you incorporate the notion that rates are going to remain lower for a much longer period of time, because of structural factors, demographics, that's not switching anytime soon. You have this enormous increase in savings in the corporate sector, where you have the 10 largest businesses by market cap in the United States that generate 2.5 times as much cash from operations as they reinvest from the business. So you have savings and investment relations that have moved in ways that have depressed real interest rates on a sustained basis. And again, once you incorporate that, you can afford a bit larger deficits.
Just one other quick point in terms of what you've been looking at. The IPOs that we've seen of late, that's concerning you, or you think it's a bullish sign when you see money going into these loss-making companies? Well,
that's the thing, that you have a banner year for IPOs, but it's a banner year for IPOs that are loss-making. In fact, if you look, there's been 130 IPOs through the end of August. Only 22 involve profitable businesses. 17%, that's the lowest share in history. The only time that we had shares this low, close to it, were 99, 2000. We know how that turned out. So I would be very concerned. Now, some of these companies are going to do very well. They're going to grow out of these issues into profits. But on average, I think you have to be concerned.
But even though the market has basically rejected WeWork, Uber and Lyft haven't exactly been successful. I mean, it's in a market that it's imposing discipline. And
to some extent, but until recently, the IPOs this year were up about 30%. There was a lot of enthusiasm. Now, is WeWork a sign? Is it idiosyncratic? Or is it a sign of changing perspectives on these loss-making businesses? But these losses are not small. The average IPO this year, negative EBITDA of $85 million. So an annualized rate of negative 100 million on average. That's, again, these aren't trivially small losses. These are very deep loss-making businesses. So I think it's something to be concerned about.
So it's low rates forever, not low rates for longer.
Well,
Got it.
As long as any of us, in any of our time horizons, from an investment perspective.
Jason Thomas, thank you.
I plan to live a very long time, but there we go. We'll see.